In simple words, value investing means buying a stock for 50 cents that is actually worth $1 and waiting for its price to catch up to its true value, then making a profit. On the other hand, growth investing involves buying a stock for $2 that is currently worth only $1, banking on its potential to grow more than the $2 in the future and profiting from that growth. So in value investing, you are paying less than what the stock is truly worth, hoping it will eventually match that value. In growth investing, you are paying more upfront, expecting the stock's value to surpass what you paid as it grows over time. These are two different ways of thinking about investing, and there is often a debate among investors as to which approach is better. In this video, we'll dive into understanding the difference between a value stock and a growth stock. And we'll also look at the last 100 years of performance of value investing versus growth investing. Now, Warren Buffett, one of the greatest investors, does not believe in this categorization of growth and value investing. So we will also listen to his perspective on the debate. My name is Kanak and welcome back to my channel. Your support is what keeps this channel running. And if you find this video helpful, then show your support by liking and subscribing to the channel. As a first step, let us understand the definition of a growth stock and a value stock. Firstly, the distinction between a growth and a value stock is often very murky, and there is not a clear rule that exactly puts a stock in one category or the other. However, a typical growth stock would be a stock that exhibits high sales growth rate and high earnings growth rate compared to the market average. And because these stocks exhibit high revenue and profit growth rates, investors tend to pay more for them for the future potential that these companies hold. So growth stocks will generally trade at an expensive valuation. Now there are two popular metrics that are commonly used to measure valuation of a company. The first valuation metric is the price to earnings ratio, which basically tells you how much money you would be paying for each dollar of company's earnings. So if a company is trading at a price to earnings ratio of 30, then you are basically paying $30 for every $1 of company's earnings. The second most popular metric to measure the valuation is price to book ratio, which basically measures what multiple of a company's net worth you are paying to buy the stock. So if a company has a price to book ratio of 5, then you are basically paying 5 times the net worth of the company to buy it. And growth stocks tend to trade at a higher price to book as well as price to earnings ratio. Now let us understand value stocks. Value stocks are to some degree the opposite of growth stocks. They tend to be companies that might not display high growth rates but tend to trade at cheaper valuation, which means they tend to trade at lower price to earnings or price to book ratios. The dominant characteristics of value companies are that they are well established, have great cash flows, are profitable, pay dividends, and might not necessarily grow at an extraordinarily high rates, but are cheaper than the overall market. Now that we know what a growth stock looks like and what a value stock looks like, let us look at the historic performance of these factors. As you can see on your screen, the gray bar represents when the value stocks did better than the growth stocks, and those yellow bars represent when the growth stocks did better. This shows that value and growth outperform each other in cycles. Over the last 100 years, from 1927 to 2022, on an average, value stocks have done better. But that's not the whole story, because averages don't tell you everything. From 1927 until 2007, there are way more grey bars than the yellow bars. But then, in 2007, the global financial crisis changed the economic landscape, and growth stocks started to outperform value stocks. And as you can see on the chart, from 2007 until 2020, there are more yellow bars than the grey bars, so performance is cyclical. Now you might be wondering, when does growth investing outperform and when does value investing outperform? Whether value or growth stocks do better depends on what's happening with the economy. When interest rates are high, value stocks do better. But when interest rates are low or dropping, that's when growth stocks tend to outperform. After the global financial crisis of 2008, interest rates in the United States stayed very low. That's one of the main reasons why growth stocks outperformed value stocks. But from World War II until the global financial crisis, interest rates in the United States were never as low as they have been since 2007. The reason interest rates impact growth and value stocks is because they affect how we value the cash flows. With value stocks, there is more cash flow in the present. So, when interest rates are high, the value of the present cash flow increases. On the flip side, growth stocks are all about cash flows in the future. When interest rates are low, the value of future cash flows look better compared to the value of the present cash flows offered by value stocks. With that said, let us listen to what Warren Buffett has to say about value versus growth investing.
I've really said that growth and value, they're indistinguishable. They're part of the same equation. or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a positive for value, but only when it means by adding capital now you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So there is no, we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it or the cash that's going to go into it. As I mentioned at Flight Safe.
So that's all for this video, and let me know your thoughts about growth or value investing in the comment section below. Thank you.